Mobile homes were never built to be managed as rentals, and people can try to make that argument, but what happens is you balloon all of the maintenance costs associated with those homes. I want to buy every single mobile home park in every major metropolitan location because those cash flowing, affordable housing, market rate, family assets, you're never going to replace. These old mobile home parks are communities full of people that are families. So cool and so special, and they're family oriented, multi-generational. Sometimes 3-4 generations live in the same dang park.
No one knows. No one has a crystal ball of what the economy is going to do, what's going to be on the horizon, what's going to happen. But the thing that I have the most conviction in is that people are going to need an affordable place to stay, and that inflation is going to continue to increase because the government cannot get out of its own way and will continue to print money, and things will just continue to get more expensive as they have for all of eternity.
Welcome to another episode of the CashFlow Quest. We're having fun with a panel discussion. We're going to cover a bunch of different topics that we're hearing a lot of chatter about, seeing online, seeing from emails and other people kind of pinging us on, hey, do you recommend these types of deals? So Ben wants to unpack some fun structures, and then we'll kind of meander through some fun dynamics within the manufactured housing space. We're seeing what a lot of the operators are chasing currently. And then we'll finish with some 2026 kind of market predictions, real estate, and then also any influences from Trump and taxes and tariffs and anything like that. So
the fun, juicy stuff.
Yeah.
Anything that starts with a T, right?
Say that 5 times fast.
Yeah.
Trump tax tariffs.
Yeah. And I think too, like one of the things that has been pretty prevalent for me is that I get asked from our investors often to like review other deals and operators that they're looking at potentially investing in. And what I've seen really kind of the last couple of months is more fun structures in the mobile home park space from new entrants. And they're, and as I'm digging through it, it's like they don't really have much of a track record. And what they're buying looks like it could be very interesting and lucrative. But I wanted to unpack today, and talk through our experience of executing on these, let's call them value add infill strategies in tertiary markets, right? And so I was reviewing one last night for a good friend client that he was trying to give some advice to his nephew of like, hey, my nephew's looking at investing in this $150K minimum, this fund. And so I'm like digging into this, into this pitch deck, trying to look at the operators. Do they have experience? Look like smart guys, but no track record. It looks like they're kind of breaking into it, buying 2,000 units across like 8 different countries, doing a 5-year fund.
Countries or states?
Oh, excuse me.
Counties, cities?
Yeah, states, excuse me.
They're over in UK. And
No, it was like 8 different states, right?
Yeah.
All across the map.
Which is hard to manage.
Yeah, 2,000 units. And as I'm reading it, I couldn't even understand what they necessarily were buying. Like the occupancy was like, 90%, but then they were saying that the percentage of park owned homes was 50%.
Yeah, I was gonna say it could be huge.
Yeah. And then the NOIs on some of them were negative, which was insane. Like they're breaking it down, and I couldn't find the addresses to look at this.
Wow.
And the structure too, it's like, 5 years to implement. I'm like, okay, so how many park owned homes are you going to sell off a year? And it was like 600 homes per year, right? And like their NOI projections were just astronomical as far as what they want to do. And they're all going to do it all in 5 years.
And there's zero track record. They've never done it before.
There's no track record in the pitch deck. I couldn't find it. It looked like they were experienced operators. They're in the space. They've done it.
Okay.
But I don't know if it's like a new team where they're coming together and doing this, but couldn't find anything on the website, anything in the pitch deck. And so I came back to the client and I was like, hey, like, I really can't even like tell you one way or another, because I don't have enough information to make an educated guess on whether or not I would do this. But I know some operators that are, if you want to go the fun route,
right,
which hopefully we can unpack too, the difference between what we do, the deal by deal versus the fund.
We've talked about doing a fund and kicked it around lots, and then we kind of come back to our structure and we can kind of tell you guys why.
Exactly.
Well, let's hammer the alarm bell that's going off for me is that there's a lot of people that ask me the question, like, why wouldn't you want to own a community full of park-owned homes?
Yeah, that's an important.
Or what's the opportunity there? And so like that's the question is like, okay, you're buying 2,000 units. What's the price you're paying per unit? if it's 50% occupied by park-owned homes. The challenges and why the NOI would be probably negative or like hurting at some of those is that you're maintaining these mobile homes, manufactured homes, depending on the year, like how old are they? Anything older than like the 90s, I call a mobile home. And then you're going into homes that are more difficult to repair. They're older. And so then you have more maintenance issues. You know, when you build apartments, you build apartments to be maintained by the operations of that deal. Mobile homes were never built to be managed as rentals.
No.
And people can try to make that argument, but what happens is you balloon all of the maintenance costs associated with those homes. And that's kind of a common like argument in the space, I would say, on the people newer to the space.
Yeah.
Now, in core markets, the opportunity is if you can take those homes and let's say you own them free and clear, you end up with all the titles. You can rotate those into a debt instrument where the people take their payment, like their rent payments, and you allocate a portion to space rents, and then you convert all of the rental income that you're allocating onto like shorter term, like they're different types of notes, you know, promissory notes, but they call them rent-owns. And you're trying to get the end user to pay down that note as fast as you can. And you're trying to basically get that home into the arms of the tenant as quickly as possible so that they bear the maintenance because they're living there.
Yep.
And that's the opportunity here. But in practice, it's really challenging to do.
I've got a lot of takes on just in general. You have a couple things. You have the operation and execution, and then you have the structure. From the op side, and just to cover this, because some people's ears might have perked up when they heard Blake say rent to own, because rent to own, because of Dodd-Frank, isn't fully legal. But when we say that, we're talking about these are like forced savings accounts in order to pre-approve tenants from a licensed loan originator, or in a situation where the paper's being handled by a licensed loan originator. So we understand that. We're not oblivious. The management of homes that are not owned by the resident themselves is substantially more cost prohibitive and involved because you have higher turnover rates, you have aging assets. And if you look at your end consumer, it's just completely different. Just like your home ownership, the way you take care of your stuff and the way that you deal with that.
That's what I was going to say.
We're talking about affordable housing. This isn't Class A multi. And a lot of times when I talk with people, it's like they're experienced operators in multi. Now they're coming into our space. And now they're looking at it as like it's the same demographic. It is not. If you're like, you know, looking for affordable housing in mobile home parks as a renter, what type of, now you might have some awesome residents, but you're going to have some that are not. And what you see is obviously that turnover kicks up. So if you're underwriting, you're looking at traditional, you know, standard MH, and it's, you know, anywhere from 2 to 6% turnover rate for the year. And now you're tacking on half of the park is rentals. I mean, you're gonna bust into 20%, 30% turnover rates. Your cost goes through the roof. It's a net loss on our portfolio for rentals. We have nice homes, we have old homes. We've looked at it all. It's usually a break even or a loss. We're trying to get those off of our books as quick as possible. There are some few examples where we run into where it's an individual owner who lives in the park, who personally vets every tenant, who manages the flip themselves on site by hand. Also, if you look at their P&L and their financials, guess what that cost is? It's free because it's the owner's sweat equity, right? So like this whole equation does not work, in my opinion. I think it's a total loss. And what are we doing? 8 states, thousands of units, 50% POH. You're talking about you have no infrastructure and staffing. You have spread communications line. It's like I'm the operator over here. My thing is pinging. My radar is going ding, 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 ding.
Risk.
Yeah,
pull up.
Sounds terrible to me. Like I would have told that potential investor, like, hey, like there's a way to skin a cat. Maybe they haven't figured out, but from my experience of 10 years doing this, I would never put my money in there.
Well,
ever.
And sometimes what's interesting of people who have experience in multifamily, and even in the mobile home park space a little bit, when you jump into that type of scale in mobile home parks and you've never done that many at once, to flip 600 homes or sell 600 homes a year and get that project done in 5 years.
If that's true,
I
it's
think
probably
that's
like 600 units
too
in
fast.
5 years.
Pardon?
Please don't tell
Well,
me
it's
they're trying to-
1,000
It's 5
units if
years.
it's 50.
5 year.
But 600 units are going to move in 5 years.
Yes.
Yeah.
Their plan is
But
to
still.
sell off.
Well, it
all
would
the
be,
POH.
Well, it would be
almost
50%.
1,000.
It would be
50%. It was
1,000.
50%, roughly 50-60% POH, 2,000 unit
They
portfolio.
have to roll them onto mortgages. That's the only way to.
That's
execute
what
right
I'm
now.
saying. There's
But-
no way you could do it that
So then
fast.
your 100, the whole absorption thing is like, if you've got that figured out, like you've already made money.
Yeah.
Correct.
Like because the people that are just getting into the game trying that, good luck.
Yeah.
It is really tough.
And like,
That's
and
my
then
point.
sorry,
Yeah.
one thought, because it's like, this is the key. If you're in markets where you have 50% park owned homes,
Yeah.
that tells me that the homes don't sell.
No,
Correct.
exactly. Which is why it's going to
And-
be even harder to move the inventory.
And when homes
Yeah.
don't sell and the markets are soft, that just elevates the risk factors
And the cost.
because now the end user can't afford the 8, 9, 10% rate that's going to cost them on the home note and on the mortgage cost. It's just like you just pull the strings on it.
Yeah.
It's really a challenging thing, which is why we chase core markets and we chase mostly, if not all, tenant-owned homes.
Yeah.
Because once that's been done, the park operates super clean and easy, and you touch a few homes a year, on scale. Maybe we touch, on a couple thousand units, or let's just say 1,000 units. We're handling 20 units, 2 to maybe 50,
Mm-hmm.
and that's still a lot for a team to handle. You got to do reno, you got to sell them, you got to have a sales team. So to do that much in bulk is pretty wild
yeah, especially in 5 years.
in
across
markets that clearly aren't like selling like hotcakes.
That's
and
aggressive.
the other risk too is that, and you could buy them right. That could always be, the other factor. If you're buying them
Mhm.
cheap enough, then there could be some room there to
But
generate
why
the
is it
return.
cheap?
But
Why is the park cheap?
But the one thing that I always come back to as well is that the market can save you when there's cap rate compression. I don't think that there's going to be much, if any, cap rate compression going
Yeah.
forward. We've kind of already seen treasuries, elevate, and now they're kind of hovering where they're at. I don't think that you're going to start to see things in like 4 caps again, right? It's
Mhm.
like for stabilized core assets, it's like a sub 5 cap, right? But you're not going to get that type of cap rate compression in like 5 years where
No.
that market will save you. If you, make a bunch of mistakes along the way, the market will kind of bail you out with just the appreciation of just overall
Yeah.
the demand for some of these assets. And so that's the other risk
Yeah.
to me. The other thing that I wanted to unpack too, and I want to ask you guys this, is when I look at these funds as well, I know even if there's 50% park owned homes, there's probably vacant pads as well, or you're going to have dilapidated homes that you have to pull. We're a dealer, but how do people infill inventory on scale if they're not a dealer? They're just going to the used market, and like, what's the risk of that? And like, just the
They're
inefficiencies.
probably going to get a license in every state, or they're going to be using like
Dealerships.
somebody that has that dealership reach,
yeah,
or they're just going to be buying retail,
yeah,
which it can be tricky, 20-30% markup on homes. And then it just perpetuates the cost and the cost to the end user resident. And,
Mhm.
and in markets where they're already 50% park owned, that infill is going to be like, it's like climbing the hill, and it's sand, and you're just like pushing, and you're sort of getting like halfway of every step you take. And then you get to the top and you have to like climb a vertical out of the sand. That's how you finish with that retail game. Like it's hard, and then it's hardest to finish.
In installing homes, I remember I got a funny story because back in the day, Blake, Jen, and Wayne brought me into a meeting, and they were like, "Hey, Tide, we want to put you in charge of installing houses," and I had never done it. And we want you to fill every vacant pad that we had. And at the time, I think it was like 200, and they wanted it done in a year. That was what they told me. And in my head, I'm like, installing houses, how hard can it be? It's going to be so easy. And I said yes, and I took it on. And it was extremely difficult. The first year, we were the 3rd largest home installer in the state of Arizona. I think we did 100 houses. Okay. So we have done this. We've experienced this. Managing the installation of homes is just like you would think. If you had a vacant parcel and you decided you want to put a mobile home there, it's a project. It takes you time. It takes you, some of these guys get it really dialed and they can get it done in a few months. But in states where you only have so many licensed contractors that have the specific license to do it, that are capable, what's the delay time on the factory? You're getting it floored. Now you're buying affordable, brand new inventory, but they have to meet state qualifications. They're getting the systems pressure tested, the electrical check. There's minor issues that get kicked back to the factory. Now you're waiting for the factory to send. I mean, it takes a ton of time, a ton of management and oversight. Now, spread that in 8 different places. You might be, if you're talking about sub-tertiary markets, how many of these vetted, qualified install teams are out there? And now, who's watching them, right? Are you watching them at your corporate team? Do you have field staff that's watching them? What happens when the sinks are overflowing and there's a broken valve? Like, what happens when there's these minor things that take time?
There's so many small details that go wrong with it, and it's got to be micromanaged.
We've had the call. I've had the call from people that are very financially capable of dealing with the risk and taking it on, but they wanted to learn and grow in the industry, so they bought deals all over
it. Yeah.
And they call me, hey, how much are you paying for your set costs? You know, and I'm like, 20 to 30 grand all in with stairs and everything, depending single wide, double wide, you know, depends a little bit on the site.
And the cost is creeping, but continue.
Yeah. And that was back 5 years ago. And he goes, man, yeah, that's what I'm getting. But I'm like, I'm back east and now, and these are in Michigan. And it just seems like a lot of money for these sets. I'm like, well, how big is the city? You know, how many set crews are out there?
Yeah.
And he's like, well, the best one, there's like 2 or 3, but the best one I found is this guy and he's pricey. I'm like, make a deal, install like 5 homes and give him his couple grand, you know, premium that you're talking about. And then give him 10 or 20 homes and negotiate. Because if you piss off, the one good set crew,
you're screwed.
Good luck with the shitty ones, you know? Yeah. And remember you and I talked about this. And we've had a set crew, they're good old boy type characters.
Yeah.
The hardest one that was really great was a girl, and she fired us. And it was like, well, see you later. We negotiated one time.
I asked for a 3% haircut. Well, the funny story is Wayne asked me to ask for it. So I asked for this 3% haircut, and I'm pretty new at the time, maybe with the company 3 or 4 years. And she gets real quiet on the phone. And we're doing like 10 installs. It wasn't that much. I mean, I forgot what the exact number was, but it was minor. And she basically cussed me out, yelled at me on the phone, hung up, and then sent this email to Blake and Wayne that was like, your employee has been lying to me and like all this stuff. And we weren't. We were, you know, it was in a negotiation, but it was a thing. I've got another horror story, and this happens sometimes, where you get a new operator, they're in a new place that they don't understand. They want cheap inventory, right? So what they do is they start looking, they go, oh, here's 15 houses in bulk I can get from the next state over, and I'm going to bring it in. Yeah. Well, then they go to get final, and the engineering is not approved by the state. It doesn't meet the code for that state, and they've already set them. They've bought the houses. They've already done the whole thing. They're going in for final. They're going through the process. Like, can you imagine that? Like, you only have that happen on one deal. It's going to take, this is a fund. It's like, yeah, this deal's doing good, but this one didn't do so good. And so we're going to take money for the whole thing.
There's just a variable that's so different in this, you know, manufactured housing space compared to multi. It's an added layer when you have this value add piece, for sure, that there's so many different things that can go wrong. You really have to budget right for all the variables.
And we've done this too. I mean, we're speaking from experience, not like banging someone else up. It's like, well, we've done it and we realize like the grass is not greener on that side.
I've literally gone through a community and just going jig, 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 and just filled homes in. And then it was not as good as we ever thought it was going to be because it cost more money. It took longer. They sell slower. They lease slower.
8 out of 10 times we're losing money on every single one of those homes.
Well,
like it's just because we'd rather have the body and the resident there paying a space rent versus not. So
and the other tricky piece is too, right? It's like the sweet spot in the gold is the sweet spot in the gold about this industry is like when they're fully occupied tenant-owned homes, right?
Yeah.
And then you're like, oh, we're going in and we have a 40% spread between in-place rents and market rents, right? And you go in there and you increase the rents. What about if you have a value-add community that is 40% below market, but you need to infill or sell 40% of the community in homes? Well, you better do that quick because you get to a point where your ability to just increase rents makes it more or less unaffordable as people are going to qualify to buy the homes. And you get in this pinch of time. And so it's like,
and it chews cash.
So
not only do you have to budget money, then you got to budget money for the money. And then then you need more cash just in case, and so what happens is you end up with so much money baked into these value add deals that the cap, if it doesn't get executed perfectly on time, then you chew money in order to provide that level of return that you started out to provide. And it ends up just kind of really weighing your returns down. I mean, honestly, that's really how it works out, unless you hit it perfect.
And you know how easy it is on a pro forma to make that thing look pretty? Here, it's going to be a 30% IRR because it's so easy, right? It's 60% occupied or whatever, right? We're going to sell this many homes a year. Yeah. We're going to increase the rents here. We're getting occupancy from 65% or 70% to in year 4, it's going to be 92%.
We've done that. We've made it look really pretty on a pro forma, and then we go to execute it and we're like, this isn't going to work.
This leads into a great story. We, at the end of the day, you got a 23, 24-year-old, finance major that's doing this underwriting for these big groups in Manhattan or Dallas or whatever. And they haven't experienced it a lot of the times. And I'm not saying that they're all this way. I'm sure there's some really sharp analysts out there that know their stuff. But we actually experienced this where I got frustrated. We were in a pipeline meeting and it was like, oh, you guys are taking too long on this deal. And I said, okay, do you think you can do it faster? And we had a competition, internal competition between me and an analyst. Okay. So we gave him 5 houses because he's like, I could find a contractor and get it done on Craigslist and we'll whip it up. It was this whole thing. So we gave him 5 houses, actually in a more desirable park. And we gave one of my regionals. I oversaw the project. We gave us 5 houses. And the competition was who can flip and sell the 5 houses first. Okay. Mm-hmm. Before his first house was completed, this is a guy underwriting deals telling me I didn't know what I was talking about. Before his first house was completed, all 5 of mine were done and we had sold our first home. And that comes from, and this was just a learning moment of we do this. I'm in the field. I'm talking to people. I know what it costs. I know how much time it takes. If my crew's telling me they're at Home Depot handing out cards trying to find contractors because we already have 7 crews running and we need an 8th or a 9th, and you're telling me you can just do it on Craigslist in 5 minutes, it's not the case. It's just not the case. And so, who is underwriting? Like you're saying, on the spreadsheet, it's real easy. And every deal that we've done that is like this performa grand slam, heavy value add deal, we've never lost investor money, but they've all been base hits. They've never been the grand slam we originally thought they would be.
That's what I mean when I say the execution wasn't what we had hoped it would be.
And it was a war zone.
Well, then it's like, we need realtors, we need sales agents, and it's like you throw money. You just keep pulling the string and it just keeps going until you finally get it occupied and then you get a big fat 10% return. Instead of a 25, it's like because you had so much money you had to put in play.
It took you 10 times the effort.
And your leverage going in was low because your in-place NOI sucks there. Yep. So it's like, oh man, I'm getting fired up over here. So and then I have all these people that have done this, right? Friends of mine, including us. And then we all get around together, after several years, holiday parties or whatever. And it's like, ooh, you know what deal we love? That one that was 100% occupied, all 10 owned, and in a core metro, and da-da-da-da. Oh, and so it's like, I'm over here thinking about deals that are coming across our desk. I'm like, God, I just have to figure out a way to buy that one and that one. And
we call
strikes. Which is why we strike. Yeah, strike mission.
Because those deals, the ones that are there, done, and you don't have to infill more than 5 to 10%. And then they're in a core metro where the affordability crisis is real in those markets. Yeah. So you have a lot of demand for a mobile home in a park. Those are the ones. Yeah. City services, what we didn't even cover. I bet you half of those have septic systems or sewer treatment plants.
I didn't even look. That information was even on there. There's very little.
Bet. $500,000 to $1 million like that on those septic systems and sewer treatment plants.
I want to take a step back though and go back to Ben's original point of fund structure. Because
we haven't even gotten into the structure.
Because listen, we've brought up a lot of experience and comments on mobile home parks are unique and they're challenging at times to manage, especially depending on variables, homes, infrastructure, vacancy, all the things. But sometimes in a fund structure, they'll have a couple value add, but then they'll have some really nice, decent 100% occupied that keep the portfolio afloat
Yeah.
while you're doing this CapEx and infill to add the value over here to maintain average cash on cash return for that fund
Yeah.
at a 4 or 5, whatever it is, depending, even if it's even that high.
I bet you it's a 2 or not.
Yeah.
Yeah,
Most
one
of them
carrot-
are like
anymore.
one
2 to
carrot and a
3.
bunch of sticks.
Exactly. So I feel like that's how these funds are able to do it, because they only have to pay a 2 and they have some decent, properties and some value add. But then that's how that works. Let's talk about that. But then let's also talk about why we've decided
not to.
not to do a fund.
Yeah.
Yeah.
Yeah. And so I remember looking at this. So the first year is 0 cash flow. And then I think second year they said 5. Third year it was like 9. Fourth year it was like 15.
No way.
You know what I mean? So like that, I mean, if you just look at that and you understand like real estate and math, it's like, wow, it's
If
like,
something's too good to be true.
Yeah,
it's
correct.
Like, and then boots on the ground.
yeah.
Todd's
But
point.
going back to Jen's
And-
point though,
yeah.
just about like
Yeah.
just fund structures in general, because we kick around funds. I mean, it would be nice to have a pooled money that you can go and strike on, because like what we do now is deal by deal syndications, its own LLC. When we get into escrow on a deal, we're going to buy it. That's when we go out and raise capital from our investors. When we're in escrow and we have 2 to 3 months, we syndicate the capital and we buy one or multiple deals in that that same LLC.
Right.
Versus if you have a fund, a blind pool fund, you generally have like a 5 to 7 year kind of investment period. Sometimes you have some extensions built in there where you can extend. You got to read into the PPM to see exactly how many extensions they have. But it's a closed-end fund. Essentially, I'm going to go out and say, these are all the things, this is what we're going to buy or hope to buy. We're going to buy 15, we're going to project a 15 IRR or 20% IRR. You're going to get this pref equity position. We're going to acquire deals for the next 2 years, but we're going to raise $100 million. We're going to get another $100 million worth of debt. And they said, go, right? Maybe
Right.
I have 1 or 2 deals already in the fund, call it,
Yeah.
to like advertise, but you don't know exactly what that fund's going to end up being, but they pool all that capital first, right? And so that does give you, from an operator, that is a convenience. Now, if I'm an investor, put my investor hat on, the problem with funds is a couple of different things, but one is you don't know what the fund, you're going to make a commitment to a fund that you don't know what the overall portfolio is going to look like.
Mhm.
The second piece with funds that I don't love is that there's no real advantageous tax strategy. So like if you do a mobile home park fund and you're like 100% bonus this year, right? And you're like, oh, this is awesome. I'm going to go and put let's say $1 million into this fund. They have a couple of deals in the portfolio. So they're going to draw all my capital, I hope, or I draw all my capital first. So I get 100% allocated to real estate that I can then get $1 million of depreciation plus, right?
Mhm.
That's great. But in 5 years, that fund is going to sell. There's no way to 1031 exchange out of a
Exactly.
fund. And if someone knows, reach out to me, because I've never seen a fund that has a 1031 exchange option. I've listened to other podcasts and tried to dig into it. I've never seen an evergreen
Usually
fund
there's
structure.
a term on them and they just end.
And they have to, right? The
they're-
closed
yeah.
end fund, and that's all in the PPM and it's regulated.
Mhm.
So that's fine and dandy, but then you have to understand that in 5 years, hopefully it does well. And let's just say for this example, it's a good operator and you crush it. You made $2 million, you use that $1 million and you depreciated your basis all the way down to 0. Now you have $2 million of capital gains that you need to figure out, right? Of what to do with. And you have depreciation recapture on the first $1 million at 25%. And so you have a massive tax liability. And if you just say, okay, well, I made money, that's great, I got a 20% IRR, then what's after tax? You're either scrambling to redeploy that into other highly depreciable real estate to then wash it, right? And you hope you have it really clean and you don't have any kind of slippage, right? Where like state taxes, California doesn't recognize bonus, et cetera. But like that to me is a problem of like from a family office or a high net worth individual. It's like, why would I do that? Right. Where I can invest and I know exactly what I'm going to buy. I can build a diversification on my end. I don't need to rely on this operator to build out the diversification for me. I can pick and choose assets as I see fit that fit my buy box. And I have the operator has the ability to 1031 exchange after. That way I can compound my cash on cash returns and not be stuck with a tax bill.
At a minimum, I have the optionality to use one of the best benefits of real estate.
Exactly.
is a 1031.
Yeah, because otherwise, like if you think about a fund and the whole bonus depreciation, I mean, we kind of chatted about this the other day.
You might as well not use it.
I wouldn't use it.
Yeah,
like, why would I
just keep it in for the long-term aspect of the cash on cash?
Correct.
Offset returns that way.
Unless like you're really skilled and you're like, no, I think 100% bonus is still going to be around in 5 to 7, 8 years. And I'll just I'll redo this again. But that's a big if and a maybe. You know, it's permanent, but it's only permanent until the next administration comes in and changes the tax code.
It makes sense that for funds you wouldn't want to use it too, because then when you sell, you're going to have more taxes owed, no recapture.
Yeah.
And so for us, we get to use the benefit. We take the first year ability to offset, taxes or capital gains or whatever income. But then we plan to do 1031s.
No,
and so you get to keep more money on the front end and then defer and keep money on the back end.
Yeah.
Mm-hmm.
And it's like, why wouldn't you want to do that?
Yeah, because you can defer for life. So, taxes and death are inevitable, but you can avoid the taxes by dying. That's all you got to do.
Well, and then the best part is,
and you get to step up
kind of a talking point.
And then the step up is basically the end of that deferral, which is the best part of the whole real estate realm, in my opinion. The kids or whoever inherits the interest gets the step up and that tax goes away. Bye.
So,
also, I feel like with your investor hat on, with the fund structure, there's kind of an incentive for us to fill the fund, right? So like we might get some great assets, but then it's like we now have this time bomb that we have to fill it. So maybe there's some snickle fritz that sneaks into the fund, and it's not like
that's so true. That happens all the time.
I was going to say, now you got $100 million worth of pressure.
Correct.
And you have to buy something.
I'm calling all the brokers. I'm talking to my guys running around. We're looking for everything. We're turning all over the stones that we can. But the good deals, there's an art to them. And they don't just happen every year, all the time, every month. So it's kind of, I feel like it's a mistake. It's more of an ebb and flow with inventory that hits the market.
Yeah.
Yep.
With the good deals versus the ones that you're just trying to slam through.
Every deal we're coming out with is a deal. We're always pumped. We're excited. We worked hard to get it.
Yeah.
It's never like, it's okay. Let's take it out. It's never like that. It's like,
I don't want my money in those deals.
Yeah.
And we're investing in all of our deals. And I'm not going to invest in a deal like that. I know way too much about operating these things.
And the money hasn't been raised yet.
No,
so you got to go, you better love that deal.
Exactly.
You know what I mean? 'Cause
Yeah.
Jen, but this deal is 50% park-owned homes. It's in 8 different states.
Score. No, thank you.
I have a deal. It's all park on. It's all park on.
That's an inside joke.
It's in Timbuktu.
Okay, here's one last thing, just because I had to bring this up as well. I also was reading, let's talk about just fees for a second on funds. Another thing that irks me.
Oh,
guess what the asset management fee was for this fund? Just like take a guess. It's the asset management fee, right? And then so tell me the percentage, and then tell me what that percentage is on.
Oh.
So it's 4%, but like on the equity.
Was it on revenue or is it on equity?
It's on equity.
Oh, I would say it's on equity, and it's probably 4, maybe 5%.
That would be insane.
Damn.
But it was 2.
I was
yeah,
say 2%.
2%,
well, like the normal
which
fund
is
structure
crazy.
2 and 20.
2.
And on scaled equity, when you can deliver double-digit returns from an operator that does really well, has a big track record, it's a fair deal.
I agree.
But yeah, it's on equity. And when you do $100 million, so that's $2 million a year.
Yes.
Going to the shop that's now got the task of deploying all that equity and making money. And that's where like the boys become men. Is the guys that can run for years and deploy capital and really do more like a sustained 10 to 15 in that realm. That's like applaud, because like that's hard to do on scale.
Yeah. Unless you're buying
2%, so $2 million a year.
Really?
AC fees probably.
Yeah.
And then acquisition fees. 2% again?
I didn't see it. Just all I saw was the management fee. It's probably 2% on the act.
And then 20% of the upside above probably an 8 pref or something like that.
Yeah, it was actually a 20% pref, and then it was a 21% IRR. I'm just going off of memory.
They're not going to make any money.
Yeah.
The operators are going to learn a lot.
They're going to get their acquisition fee.
They're going to get their
and their asset management fee, and they're not going to get anything else.
But versus we go back and forth over this too, and this is what's really important. It's not just the percentages. You have to always calculate what it's on. We do our asset management fee on revenue, which is so much smaller than the actual equity. And like say if you do a 2% asset management fee, because there's payroll and you want to pay for talent, right? You want to have really smart people that are managing and overseeing your money. So if you do that on like say revenue, which is the way we do it, versus equity, it's substantially smaller doing it on the revenue. I like 2% on just like what the property produces versus doing it on equity. I mean, it's like it pales in comparison. So that's why sometimes I always am educating people like, okay, how do you think about fees? And when they ask like, what are your fees? Right. And I tell them like, but hold on, you have to understand this percentage is on revenue, not on equity. Yeah. So it's much smaller.
And it was formatted because we learned from a property manager syndicator, and that's really where we came. We were property managers and then syndicators. Mm-hmm. And so we always come from the reality, boots on the ground. Are we going to be able to collect the revenue at this level? And if you put that much of a fee on the equity, it breaks the ability to just hold and cash flow. Yeah. And so that's like there's so many layers to this, but now you're that much more motivated to onboard the money, go deploy it, and then sell as fast as you can. The only way to hit 20s is you got to take an IRR and you got to turn them in like 3 to 4 years.
Yeah.
Because that's the only way to get an IRR up above 20 in this case. And so, I mean, if they had been doing this for 10 years, hey, I'll happily learn something. Yeah. But like when it's an operator that really hasn't done it, everyone's chasing yield. Multifamily is tricky right now. I would caution anybody that is really chasing huge returns. Yeah. Like, the risk is also there and equivalent to the maybe returns.
Yeah.
And why would you want to give all this money to a group, right? And then they're getting paid right out the gate off of your equity, right? And with us, you have to earn it. You have to perform on financials. You have to be raising the rents. You have to be effectively managing the assets in order to get legitimate asset management fees. Whereas like this, you just get paid for being in the game. Like it's just,
that's a good way to put it.
You show up and you're paid.
And they're probably hiring a third-party property manager.
I would imagine.
Maybe not, which then adds to the complications that Ty's mentioning on property management across 8 states and the legal aspects and all that.
Yeah, that's another layer of challenge.
It's interesting. So that's why we haven't. If the fund is a good tool for people that have grown to that level, but the people that I know that have done it successfully started deal by deal, and like if we were to go out and try to buy everything, we could have grown faster. But we want our name and our reputation and our ability to perform is more important than just pure short-term revenue. And so, that's where we're now in our scaling phase because we've learned a lot along the way. And we have learned what assets, what markets, and, to go into sections, like go into states and cities and build teams and then start to move along.
Yeah. Become experts in that city or that MSA and really learn and then build scale, build a portfolio, build a proof of concept, and then move on to the next one. Yeah, because the scattershot approach, and one of Brad Johnson, I'll give him a shout out. Skilled operator, did a sold off, rolled out, and now he invests with us directly.
Shout out Brad.
Yeah, great guy, very smart guy, and he's like, I love what you guys are doing. You guys are so smart. That was one mistake I made was that we did a scattershot approach and they rolled it all up to an institution, but they got hit on the pricing on that. Mm-hmm. He's like, if you buy, he's like, what I really love about you guys is you take this measured approach and you buy in select markets and create portfolios. And so he now is, has exited and has made his money, but is still in the game and he invests directly with us. And he complements that piece about us. He just likes how we're measured and how we think about it as biting off chunks into MSAs and building scale versus doing a scattershot approach.
Brad. Yeah.
I think one of the magic parts of what we're doing is when you select a location and build and develop teams, you get this huge, basically boost on your P&L. And we're seeing this right now. We have a property where the person who's there most of the time, their total all-in cost is $59,000. The community is being billed $57,000 in payroll, all in. That includes our costs on the back end as well. Mm-hmm. But it's not just that one person. They have a supervisor overseeing that person, a regional overseeing that person, a quality control that tours the communities, and they have a sales and leasing agent. It's all paid off of that. So for the price of one person, the primary person, you're getting a team cost that is helping aid the effective management of the community. And the park's clean. It's running a 94% occupancy. It's fully stabilized. It's cash flowing. It's getting increases in distributions. Like, it is exactly what comes from foundational development through staffing, in my opinion. And I think that comes from professional management.
At the end of the day, it's
a team sport.
Yeah. It's a people business.
Yeah. You play to people's strengths for sure. Okay. Predictions 2026.
Yeah.
What are we predicting?
We're inside of a month from the end of the year.
Crazy. Rather than talking more like policy and like Trump and like macro, I do think that next year is going to be a great year for deal flow. I just have that feeling.
Me
like
too.
people are ready. They kind of have, now we have a new administration that the 10-year treasury has kind of like stayed pretty stable. You know, people have an understanding of valuations.
The
I think,
uncertainty has like calmed.
yeah. And I think that we're going to see lots of deal flow into next year, as we saw this year, at least for us. Like, we had a pretty big year. I think next year is going to be very similar to that.
Yeah, I think the multi-year planning. So if you're getting tired of operating real estate assets and you're starting to plan multi-generational, maneuvering, you want to do it with a good couple of years worth of time.
Yes.
And so that's, I'd say, now being where we're at today, having hindsight of chasing mobile home parks for like pushing 17 years, you need a year or two to kind of do that. And nobody likes to send and sell stuff unless they're pros. Mom and pop sell like the first 1, 2, or maybe the third quarter.
Yeah.
So I'm hearing a ton of deals that are getting into the starting blocks to go out with marketing packages, and brokers are doing a lot of wrapping up sales functions and putting the OMs together to come out with deals in January. Call it the first week or two in January.
I know.
So, and then other acquisitions guys are feeling the same way. So, because I chat with a lot of people and we sell to them, we also just become friends, and so we can kind of compare notes on what they're buying, what we're buying. And it's the consensus is that. And so there's a big pipeline. It's ballooning, I'd say, to go out the first quarter, maybe second quarter of next year. Debt and equity and things have sort of settled down to normal. The people that are still buying are now pros. I feel like there's less of the noise in the market, in that you're not, if you can't make sense of the core market deals like we bought in Phoenix and Dallas last year and this year, if you can't make sense of those deals, you're not even coming close.
You're out. So just curious real quick on this. What do you think that is? Is this a perception issue?
Why are people not coming to price and being competitive?
Yeah.
In the end, you have to be able to drive revenue, and you have to do that in one of two ways. You're either chasing the infill properties, which we just hammered, and the value add stuff, which is really tough. So the guys that have tried that over the last cycle are more focused on core assets, which is kind of where we stand. But also we know where rents are now, sharper than ever, because we have deals there. So we have boots on the ground. We have assets that we're already collecting at certain levels. So if you buy an asset down the street or next county over, within a few percentage points what you can hit. If you don't have the confidence of the data backing you, it's hard to pull the trigger.
Yeah. And just that's such a good example, because that deal in particular is one of those. And I feel like you could say that across the board this year, last couple of years, but especially like thinking about the new year, the folks that have that context like us and can do that, the values are going to run away in the next 5 years, where people are going to be like, holy crap, why didn't we buy all of that stuff that Comfort bought? Because it's just going to be a function of the continued demand of the asset class because of the resiliency. But it really is going to have to do with the income growth, the rents, and where they're going to see, oh my gosh, these communities are 98% collecting with like no bad rent payments, maybe 1%, 2% across the portfolio, and they're collecting at 1,000 plus. And now the price per pad is almost double where I could have bought it at 5 years ago. And yeah, there's a lot of work and CapEx and stuff that went into that, but that's where I think that the opportunity, it's like almost like kind of showing our cards right now. The opportunity is right now. And it's been like this in the industry for a long time, but the consolidation of the asset class, I feel like it's going to be a moment of time. And we talk about it too. There's going to be a moment of time of these core assets that are still under rented, mismanaged. People don't have a kind of a good sight on what the future holds on rents. That is all going to get exposed in the next, I think, 5 to 10 years on core locations.
I'll take a fun tangent for supply and demand dynamics, which is like Eric Trump and some other guys are building like this Bitcoin mining real estate, stock market play. It's a public company, and they're out there preaching that, we're going to mine and capture Bitcoin because once there's 21 million Bitcoin, that's it. And then they're just going to balloon in value. Well, great. You guys have fun. I want to buy every single mobile home park in every major metropolitan location because those cash flowing, affordable housing, market rate, family assets, you're never going to replace.
No.
The city's grown around them. They're let's say they're $500 to $1,000 rents. You got 10, 20, 30 acres in the middle of the town pumping money. And it's like, how do you beat that from an asset standpoint? Like, you can build multi and you can keep going vertical, but these mobile home parks are like mining for gold. And then they spin off a cash return. They give you the tax incentives. Like and there's no inventory coming online.
And then the last piece too, that with going back and I think tying this all together is like the fix and flip shops, the funds, they miss the real magic because what happens is just to your point, as you put in the hard work, the blood, sweat, and tears, what Jen and Tide are doing day in and day out of like revitalizing and bringing these communities up. And once they're stabilized and they're pumping cash, your expense ratio just starts to drop. And then they just become cash cows. And then the cap rates, because they're stabilized, just compress.
When you do that and have a grouping in a particular area, the cap rate compresses potentially even further because you can get scale.
You have scale.
That's well managed and occupied. Yeah.
And the institutions know that these are like bond level real estate assets.
And so do all the agencies as well. That's why we get better pricing on loans from Fannie and Freddie than Class A multi. Mm-hmm. So our spread, because there's so much demand on the secondary market to own MHC paper, because it's the default risk is like zero.
And I mean, we're talking about all of this like equity and revenue and growth from a gold and all of this from a financial benefit. But there's also like an inherent good cause where we're protecting affordable housing for tenants.
Yeah.
Like rents are going up, period, but we're still extremely affordable. We're like at half of what multi rents are. And still hitting our performa, still delivering for our investors. And we're protecting this awesome investment class for people that need affordable housing. And I think that there's something special about that. Like,
100%.
We love to talk the deals and the performance of them. But ultimately, there is this moral value that we're doing that mining for Bitcoin does not bring you. You don't go at home at the end of the day and go, wow, I mined Bitcoin and made money. Yeah, maybe. But like, at the end of the day, you're not feeling like you've improved the world, where I do think we are. Like we're going in where people cry over this stuff. I mean, brand new clubhouses, we're getting all the riffraff kicked out, people dealing drugs or whatever is happening, all the clutter, all the hoarders. And at the end of the day, I'm a Christian man and that's something that's important to me. And like I can go to sleep at night knowing I'm helping people and making a better community where we are touching. And I think that's important.
And giving those residents who do own their homes an added value on that home. So yes, we're raising rents, but for that, we're improving these communities dramatically sometimes. And with that comes added value in their home ownership, where the home wouldn't be worth nearly as much in a rundown, mismanaged community.
100%.
Yeah, these old mobile home parks are communities full of people that are
families.
So cool and so special, and they're family oriented, multi-generational. Sometimes 3-4 generations live in the same dang park.
Yeah.
And so to go in and spend money and unearth and bring and shine up these assets,
it's really cool to watch.
It's so cool.
It's
an underserved market that really is pretty wild that people haven't until now. Like we're still buying these deals that are so like unbelievably unkept.
The clubhouse sometimes hasn't been open since 1985. Like what?
This asset class allows people to live in the cities that they grew up in.
Right.
You know what I mean? They don't have to say, oh my gosh, like my mom lives in a mobile home, manufactured home in San Diego. the fact that she could live in and it's 100% occupied, no houses come on sale, right? But the fact that she's able to stay in San Diego is because of a manufactured housing community.
Yeah.
Otherwise, she would be priced out of the market and she would have to move somewhere else. You know,
it's the number one issue for Americans. Always talked about is the affordability of housing.
Yeah.
And what we're seeing now is when they're doing all of these assessment and questionnaires with the youth, they're becoming way more open and way more positive about manufactured housing.
That's a fact. Yeah.
And that's because, and we like to focus on family parks, and it's because it's a great opportunity. And, you know, we talk about raising rents, but ultimately we're really bringing rents to market. You know, we're always in the middle of the pack. There's other operators higher in rents than we are. We're not driving out crazy. We're saying, hey, this is an affordable option, and that is our focus. So our underwriting is just taking to what it should be, and then we're improving it, we're managing it, and it's a special thing.
And it's worthy of defending it. You know, to that your point that you made to kick this off, we need to defend the affordable housing stock in all of these core city locations, especially. And so, like another one of our friend that operates, he makes this point really clearly too. It's like there's nobody fighting for them. Funny enough, the cities hate us. But then we go in and we make it a lot better. And it's like, oh, the cities don't like it because it was run down.
Yeah.
You know, and
so
like
operate it correctly. It's
spend
affordable
a little
housing.
bit of money on it.
All the cities are trying to create more affordable housing. Well, these are great options. Why not build more? Why not let operators like us come in and operate them? So, you know, we're excited when we're able to get our hands on a deal that's in a city that's run down, because it's a fantastic opportunity to improve the asset and improve those wonderful families who live there's lives.
Yeah. Amen.
For people that are newer, it's like if you ever bump into a mobile home park that is run down and you're like, whoa, that's kind of a raspy trailer park. Like I probably wouldn't feel safe in there. Those are the communities that we go in and make them really nice, you know? And it takes a few years, 3 to 5 years to turn them around, but then everyone loves it. You build a new sense of community. People and the tier of people that you're bringing in are higher quality. They're just the whole thing gets cleaned up and starts to sparkle. And it's really magical to go kind of like, you know, Chip and Joanna Gaines did on the very beginning of Magnolia, but we flipped trailer parks.
and I think too, like even just the difference between why we're so passionate about being long-term owners and operators of these versus doing the fix and flip shop is because we take an owner long-term mindset on these assets versus like hot potato. We got to sell this thing in 5 years because the IRR is starting to drip and we're not going to make any money.
Yeah.
If it falls below this, it's like, no, like put the money in. This is going to be a part of us for a long time, drive the value to the tenants, and everyone wins in those scenarios.
100%.
Taking a more long-term ownership mindset versus a fix and flip.
It's way more fun too, by the way. Why would you want to have a hot potato pressure on your hand?
We've done it. I mean, we've flipped a couple of deals and it is like exhausting.
It is.
And then you just have to perpetually keep chasing deals. And it's like, versus if you take good quality assets that you buy at a fair market rate for what it is. Let's say it's less than optimized. It's under rented. It's dirty, not well kept, all those things, the mom and pop kind of method that they haven't really spent any money on the place. And it's just 20, 30 years gone downhill. But now you get to spend 10 years making a community great. And when you get done, they are great, humming, cash producing real estate investments.
Yep.
We have like my favorite park. I just did a tour. You know, I hit, I think 24 parks in 4 days. I was all over Arizona. And one of my favorite parks that we've had is Romero. From an aesthetic standpoint, Romero is on Romero Road. And for those of you who know Tucson, that was the red light district before they really harped down on it. But it had a major prostitution issue. And we made an offer and a run at it in, I think, 2019. And I went and I called Blake from the park and said, do not buy this park. In the park, it was like 2 p.m. on a Wednesday. And it was popping. I mean, there were golf carts and big cars with huge rims and bass bumping out of the trunk and things getting handed off of, porches. I was watching, I worked in the ghetto in San Diego for a period of time in my life. And I know when I see a drug deal and like it was happening, like there was a lot of methamphetamine in the park. It just had issues. And large vacancy rate, really rundown houses. The clubhouse wasn't open. I mean, just all these things.
That was a clubhouse from the 85 that had sat for a very long time.
That's right. And I think that it was 40% of the community was park-owned inventory that was being rented. And so we've gone in and every house that turns over from a renter, we fully remodel. We check for safety. We put in mini splits. We paint the exterior of the home. We clean out all the clutter. We've enforced covenant enforcement. So we have like lots of residents who have cleaned up. We just redid the clubhouse. We did the front entry. All of these things are happening. And now you go and it's just astonishing. Like you're in a place and you're like, this is crazy that for 20 grand, you can buy a fully remodeled house and live here with a pool that's open, with a clubhouse that's open in a central area in Tucson where houses are trading for 100K or whatever, 200K. And it's really cool. It's really rewarding, special.
Well, let's wrap up with we drifted back to our favorite asset class and how much we love it. But okay, so is interest rates? What do we think for 2026?
Going down.
Standard home buyer, 30-year mortgage. What's it gonna be roughly?
So I think on my home, I'm gonna save a point and refi again next year around September. That's what I'm banking on.
My guess is they're going to hold in December on the next one. And I think that we're going to see a couple rate cuts next year.
I think the 10-year stays around this handle for into next year.
All year?
All year. I'll say I think it bounces between let's call it 3.8 on the low end to 4.3 on the higher end. Right, so what does that give me? 50 basis points of spread?
I'm taking the low end of that. I'm thinking 3.5 to 4.1.
I like that.
So Ben is at about par.
Yeah, 3.8 to 4.3. I think, it's 50 basis points.
Jen
of spread.
is, what do you think?
3.5 to 4.1.
3.5 to 4.1.
You
gotta just pick it. It's like Price is Right.
3.6.
It's like whoever's closest.
3.6.
3.6.
This time next year?
Okay.
Yeah.
3.6.
Right. I'm doing 10-year now, and then I'll get your all in.
What was yours?
I'll say 4 right now. This time next year.
What's yours, Blake?
I think the 10-year treasury is going to drift like a half a percent throughout the whole year. So I think it's just going to kind of slowly go towards 3.5.
Okay.
I feel like there might be some like cat in the hat moment that really affects it either way. I'll do 3.75.
Okay.
So we're all predicting pretty good rates for next year because I'd be happy with in that range.
I think overarching kind of consensus that I would say all 3 of us are making all 4 of us are making the bet of is stability.
Yes.
An interesting little snippet that I thought might be fun to read right now. These are various US Bank, Yahoo Finance, and BlackRock think.
Who cares what BlackRock thinks?
The Federal Reserve cut rates by quarter percent in October to a range of 3.75 to 4.
Yep.
That's what US Bank's saying. The Fed's dot plot signals 2 more rate cuts in 2025, bringing the benchmark toward 3.5 to 3.75 by year end, with 1 additional cut projected for 2026. The Fed's projections indicate a target rate of 3.6% by the end of 2025 and a 3.4% by the end of 2026.
So, yeah, and my theory is that, and I read this, so it's not just me. I think that wherever the Fed funds rate lands at, I think you're 75 bips to 90 bips on top of that, and that brings you to your 10-year.
Okay.
So that's kind of why I even think 4, I think it's going to be around this range. 4 is a really good rate.
So what is the average interest rate right now for a mortgage?
30-year mortgage.
Right? Because right now the U.S. Treasury is at a 4.06.
That's a really tough one. Mortgage rates don't tie directly to...
Oh, I thought I was dumb and they do.
No.
I thought they're identical.
I'll tell you exactly how it works. And it's quite simple, actually. So all of the mortgage companies are making loans and then they pool them and they sell them. Well, if they with the volatility in the treasury, when they originate the paper versus when they sell the loan mortgage to another company in bulk, they need to have a spread to make enough money to pay themselves, like make a fee on the origination plus the cost to sell it. But then also the buyer has a particular risk tolerance on what they're willing to take as an interest rate. And so if you originate a loan right now and the treasury's wandering, you got to build in a risk factor, just like reserves. You have to build in, well, it's going to be 6.25 today because I know I can sell that mortgage. Whereas if you go at 5.8 right now, there might be no bid on that. And you end up having to keep it on the bank's balance sheet. So they're building in a factor for error on the treasury. So the more stability for the treasury, the more tight the market can get on mortgages.
So if this goes into 3.4, 3.5 area, where do you think interest rates on conventional mortgages are going to land?
I think they'll step down, probably tighten up 20 bips. So you end up at like 5.5. So Jen thinks 1% down. So she thinks 5.25.
For a mortgage, I was thinking 5.5, like all in, but I could take the lower bet. I'll take 4.25 or 5.25.
5.25.
I mean, that would be awesome.
I think there's a shot.
And doesn't that
There's a shot.
align with your 200 bips?
That would be the treasury going down to like more like 3.25 in the 200 bip scenario, 2 points or 200
So maybe
bips.
the margin will be 150.
You could get in
I'm just
there.
saying
It
it's
could
in the
tuck
ballpark.
Yeah,
I'm just saying it's in the ballpark.
200 bips might go to 150 bips.
Yeah.
All right. So
and that would align with my 3.5.
so then tied all-in interest rate for end of 2026 for this 30-year mortgage product.
I think 5.5, fine.
Okay, 5.5.
Okay.
Then
End of year, fixed rate mortgage, 30-year mortgages.
I'll take 5.75 just because I think the banks are greedy. So I think they'll maybe not reduce spread, and I think the housing market demand will keep them
happy
and allow for the banks to continue to sell that spread.
Yeah.
You know what I'm saying?
I was reading today that the vacancy is starting to drop. The wave is kind of ending and we're about to boot up again.
For multifamily.
Yep. And
Absorption's happening,
The absorption is happening, and they're not building as many units, as fast. So the absorption rate is catching up.
I feel like there's a lot of chatter about stock or about tech being in a bubble. I do think it's a little inflated, but now we're starting to see some of these earnings reports come out. And so there's a little more stability there. And then I was just watching this thing with Patrick Bet-David. He had Lee Zeldin on with the EPA. And they're talking about all these rollbacks that they're doing and all these large energy projects that are basically finishing construction now. And we're going to start seeing onboarding of employment and like huge energy projects in the Midwest and the East Coast that like, I just think we're going to start to see, we have job losses from the federal government affecting the jobs report. I think if we start to see a boost in labor, we start to see absorption come out. We have interest rates dropping. I think that this is all feeding into what I've been saying.
Inflation, perfect segue into inflation prediction. I'm just having fun.
2.6
clear-cut measure.
2.8, something like that.
So my fact is saying the annual inflation rate stood at 3% for the 12 months ending September 2025.
It's been about 3%. I think that's going to continue. And I think inflation is here for the long term. I don't think it's going to be runaway inflation. So that's why I want them to update their dual mandate on the price stability from 2% to 3%. The problem is going to be, and this is really where it goes back to what we're just talking about, is the labor market. So if the labor market falls out, that is going to be where you'll see the Fed step in and probably not worry as much about inflation and start cutting rates more precipitously than they currently are pricing.
If labor falls out, what does that mean? I'm just making sure it's clear.
Unemployment increases.
Got it.
Yeah,
it has increased. I think it's like at 4.4. But part of that is because this administration is cutting so many government jobs. And I'm not saying that's the only thing that's happening, but I think that is playing a part. I think it's affecting it.
And then as a one of like the red flags that's being flown around by the gold bug guys right now and macroeconomics guys is that the repo market's like buzzing, like the red flash, is going off.
Mm-hmm.
And the Fed is having like emergency meetings. They're having to infuse like 125 billion right now. This is the overnight banking repo system where like money's moving back and forth to generate interest for banking institutions with deposits, all that stuff. What happens is if demand falls off for that and it doesn't just click back and forth, the Fed that's like one of its key indicators that it's going to have to step in and infuse liquidity into the machine with money supply.
Yeah.
And we're in a weird dynamic. We've gone adrift. I don't think anyone fully understands where this is going to play out from a macro standpoint, which is why gold basically doubled this year. And so we have a moment right now, which is similar to September 2019, where the Fed's having to get emergency meetings, infuse capital into the repo world on the banking repo side.
Yeah.
And then that typically indicates quantitative easing or money supply coming in which case they would go a red alert and then they bring rates down in more of an emergency dynamic. So to keep the economy stimulated, to keep the velocity of dollars moving, because if everyone gets fearful and holds, that actually is more crippling.
Yep.
So
What does that do to the value of houses in San Diego, Blake?
if they bring rates down, value is just going to go up crazy.
Yeah.
I mean, even just momentarily, at least a couple percent.
I think the economy is on really shaky grounds. And I've been talking about this, in our meetings and so forth. And I sold, we don't have a lot, all my money's in real estate in our parks, but I sold all of our stocks and I'm just sitting on cash. That's my personal opinion. I think that there'll be a correction. I think with Trump and I never want to underestimate monetary policy and the creativity that they can come up with. But I think that we're going to see some bumps along the way. And what you're talking about, the repo market, the Fed was offloading their balance sheet, as far as selling off loans. They're now starting to pick back their repurchasing. I think that there is enough things out there, if you're paying attention, to be a little bit cautious of where you have your money. And I think there's no better place than in mobile home parks, personally.
Da, 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 da.
So I think inflation will be roughly 3.5. I think it'll ebb up because I think they're going to have to spur some growth dynamics by reducing rates or do something. They're going to have to stimulate the economy.
I was saying, or reading something too, where because of the tariffs, that cost will be pushed to the end consumer too. So costs are still going up,
but they
because
aren't
of various
seeing
reasons.
that big time. It never has really materialized. That has been such a conversation
For
this
the
whole
tariff
year.
side.
Yeah.
For the tariff side. That's just what I was reading.
It's tricky.
Yeah.
It's tricky.
I feel like all of these things are yield signs, right? I agree with you. There's a lot to show us to be cautious, but I feel like we haven't had any of the net benefit that's been discussed. Like tariff policy has really been a huge stop sign in the economy this year. Like everybody's like, well, what are we doing? Think about how many businesses are affected by tariff policy with China.
What I'm trying to pin down is like the projection on this, or your take on what's going to happen in 2026 with inflation and interest rates are kind of two mechanisms to kind of sentiment, lock down what you believe the sentiment's going to be. So you're saying inflation is what in 2026?
I think it's going to bubble up to like 3.5, but then it's going to come back down. And we're going to, in 2026 at the end, we're going to end up right where we are about now.
I'll say
3.
3?
I think we're going to end back up at 3 this time next year.
All right, Tide.
Well, I still think that that's an elevated. We're currently at an elevated inflation rate,
Correct.
right? So I think we could stay pretty similar to what we're at.
Okay, no, it's fair. I'm just putting it down so we can have this conversation ongoing.
Yeah.
We can revisit midway through the year, and we can collect on bets if need be. Those are the big fun ones. I think that there's an interesting dynamic going on. There's talk on stagflation. Being the case, like if that's going to take or not, it's like, hold on, let's see what happens.
Yeah.
And, from our perspective, I think I can speak for all four of us. We want to buy every mobile home park in core locations because we're betting indefinitely on the affordable housing market within manufactured housing communities being a solid long-term hedge against all the volatility.
Exactly.
I think that's pretty much it.
Yeah.
Yeah. It's like, we don't know, but the thing I have the most certainty in is mobile home parks. And it's an inflation hedge. And I know that it's the most recession resilient asset class. And so that's why I feel the most confident. I have this conversation with investors all the time. I mean, we have investors that ran, $1 billion hedge funds, long short, that are retired now and are investing with us, that I talk to all the way down to the contractor, right? And across all those conversations, at the end of the day, no one knows, no one has a crystal ball of what the economy is going to do, what's going to be on the horizon, what's going to happen. But the thing that I have the most conviction in is that people are going to need an affordable place to stay, and that inflation is going to continue to increase because the government cannot get out of its own way and will continue to print money, and things will just continue to get more expensive as they have for all of eternity.
With fiat currency. Yep.
Correct.
Thanks for joining us for another episode of the Cashflow Quest. I hope we got a bunch of value out of this one, and we had a lot of fun doing it. Thanks for joining us, and we'd love to, in the comments, hear your prediction for 2026. Cheers, and thanks for joining us.
Cheers, guys. See ya.
Yeah.